You know I try to be a good man, I always give it my best. But truth be told, someday I wanna go to the wild, wild west.
And now, live from our Smokehouse studio, it's time for Real Estate Jerky. All your real estate questions answered by a provocatively lean expert host, Ed Parcaut, MBA, veteran, and president of Lending for Living. And today's special expert guest, real estate advice you won't find anywhere else. Plenty to chew on, starting now.
Good afternoon. It's great to be here with my guest, Tom Bryant, who is an expert financial advisor and managing director of the investment consulting group in Modesto. Good afternoon, Tom. How you doing?
I'm fine, Ed. How are you?
Doing good. Now, you were on the show, was it a year ago, 6 months ago?
Last summer.
Yeah. And before we get into all that, I just want to remind our listeners why we do the show. The reason we do the show is it's important for people to buy homes and build personal wealth and other stuff because a lot of people don't have 401ks, 403bs, investments, so the only place that they find wealth is through their home. Do you believe in that, Tom? You think it's important for people to own a home?
It's always important to build wealth, and a home is a good start.
Right, because if you don't have anything else, at least you have something helping you, and you can always work for more, correct?
I wholeheartedly agree.
I was trying to help them do your voice again because you're a little bit louder on the mic.
Sorry.
So you're good now. All right, so last time you were here, there were signs of recession, right? We talked about the signs of recession, the inverted yield curve, and I forget something about gold. What were the signs of recession before? Do you remember?
We had several things. The only one that we were looking at was the inverted yield curve, but we also discussed wage increases in wages,
right.
So pressure on wages and unemployment.
Okay. And where are we now with all those? No inverted yield curve because they lowered the Fed funds rate, right?
The Fed responded with a lower interest rate. Yep, one tick lower,
enough to get us out those.
The yield curve corrected itself. Yes.
Yeah. Where are we with wages?
Wages are still increasing. We're at about almost a 4% increase in wages, and that is a healthy average. It's not ridiculously high. It's not a concern for a recession.
Okay, and then the third one was?
Well, it was the Fed. There was the Fed rate.
Right, we did that.
Fed rate, wages,
and besides gold. I mean, I think we talked about.
You talked about gold,
yeah.
But we also talked about.
And I'm going to scold you right now.
We also talked about
in your chair. You're messing with my engineers.
We also talked about inflation.
So inflation, not there, right?
Well, it's there, but it's manageable. It's 2.6.
It's exactly what the Fed wants.
It's exactly where we want to be.
Right, because you don't want no inflation, because then nothing happens, right? Stagnation.
No inflation is stagnation or recession. Yeah,
we don't want that.
It's not good for the economy. We want to
grow. You sent me an article a while back regarding the tax cut, right? The Trump tax cut, right?
That article was on the benefits and how it's benefited the economy.
Right. But I remember before that, when it first happened, I don't think you were 100% on board of the tax cut, were you?
Well,
I mean, you're a financial advisor, so I'm just trying to understand, because the article you sent me said how much it benefited the lower end people, which everybody says it didn't benefit. It only benefited the wealthy and the business owners and all that, right?
So my clientele are people that have accumulated wealth, and they generally have one or two or more homes, and they're the people that are generally high-income earners. And I say high income, above $300,000 or $400,000. So those are the people that got hurt through the tax cut. The people that benefited were the people that made less than $150,000 a year, had families, one home. They benefited tremendously from the tax cut. But the people that were making more were hurt. We lost our deduction on property taxes beyond $10,000. State income tax deduction went away. So those people are actually paying more in federal income tax. The uber rich don't care. They're insulated from everything.
Right. But I mean, if you listen if you listen to TV and you listen to people running for office, and they're all talking about how bad it is for those people who just benefited the most. Right.
It's only bad for those that are
above what you just.
That's right.
Well, I'm just saying, but and I don't care if you're Republican, Democrat, whatever you are, but we're hearing out there the people running who are saying that the tax cut didn't benefit the low income people.
There was a huge misunderstanding about what the tax cut did. A lot of people, I walked into our Rotary Club one morning, and one person said to me, "I'm so upset about the tax cut. There's no tax cut. I lost my deductions, all my deductions." And I looked at that individual and said, "You've got to be kidding me." I said, "Your standard deduction just tripled,
right?
And so you don't even need to itemize anymore. Right. So you're going to take home more." I have employees that make six figures that got all their income tax that they had withheld back this year because of the standard deduction rising. So, and they're families with 3 or 4 kids, so they benefited dramatically.
Right, and that's why we used to say buy a home for the tax benefits, right?
There are still tax benefits for a single homeowner. Yeah.
But truly, most people take the standard deduction if they're married, and that's more than they're going to itemize. So for most people, that's why I don't talk about tax benefits. I talk about building personal wealth through home ownership.
Right. Well, it's much
because that's basically what happens.
You and I both agree it's better to pay a payment on a home and build wealth than to pay a rent payment and to build someone else's wealth.
Yes, very much so.
Yeah.
And plus, you have no security. That rent can go up. Only 7% a year now, but with the rent protection that we have. However, it still can go up over time. I've seen people who've been in the same home for 20 years now can't afford the rent anymore.
Yeah, well, and property taxes still go up a little bit. And
it's not getting into that property tax thing because that's biting me too because they're trying to get rid of Prop 13, which protects us.
And everybody's passing bond issues for school districts, which make your property tax go up.
Right, and those are usually in the newer tracks, right? Or they've been there, the Mellorews and stuff like that in the newer tracks. And so they're there. The problem with the Mellorews is it never goes away. They always increase it or they do stuff. So I want to get off the stuff that I'm really irritated about right now. Let's just get into the market.
We could spend days on what irritates you and a couple days on what irritates me. So let's talk about positive things.
Right. And I think I forgot to tell you we have about 3 minutes on this segment. It's 10 minutes.
Okay.
So let's get back to the market. Or what did unemployment rate? I have some here about figures that are pretty interesting. Unemployment rates. The government began tracking in 1929, which was at 3.2, the lowest level ever. And now, unemployment rates are so low right now.
The lowest they've been since 1964.
Wow.
So 50 years, 55 years, it's been hasn't been this low. So the unemployment rate being that low means that those that were unemployed or unemployable now have jobs. And that's all happened in the last 3 years. So that's an incredible benefit to society as a whole.
Right. The problem now is we can't find enough people for jobs. Right. Because people can, go get a job and then someone else offers them, hey, you do that? I come over here and work for me.
Yeah.
Right?
Well, skilled labor is hard to come by and they pay quite a bit. Those that were unemployable in the past are now finding jobs. And those are mostly in service sector, restaurants, gas stations, that type of thing,
And, they're getting rid of the McDonald's employees, right? Doing that all automated.
Well,
right?
If you're going to raise the
minimum wage
to $15 an hour, are people willing to pay $30 for a McDonald's dinner? I don't know.
And there's a lot to the, people having a wage and, some people, but go get a skilled job. You don't have to go to college anymore. Go get a trade. Go learn a trade because, trades make so much money. Truck drivers alone right now, you have to go to Texas. There's a ton of them needed. They're needed here. We have a shortage. We have a shortage of construction people because a lot of people didn't want to go in the construction field because of the downturn. So there's a lot of jobs. It's just maybe it's not the job you want, but maybe a job for now, right?
Sounds good. Yeah, I have trouble finding electricians to come and work. I have a gentleman that owns the HVAC company who can't find people to fulfill the positions, and they pay quite well.
I was surprised where I was able to pick up my employees lately and be able to pay them a lot more than they were making at other companies, and it's amazing. Yeah. Because we're slammed right now with rates so low and people buying homes, and it's just amazing how low rates are and what people can do and how cheap a payment is. It's so much cheaper to buy than it is to rent right now. And if you don't own a home, you need to go talk to somebody about owning a home. Hey, we're going to go to a break. So, hey, we'll be right back with my guest, Tom Bryant. He is the expert financial advisor and managing director of the investment consulting group here in Modesto. If you've got questions or comments, dial pound 250, say the key phrase real estate jerky. Again, that's pound 250, key phrase real estate jerkies. Leave us a message or question, and we'll get right back to you. All right, we've got 12 more minutes. Next segment, 12 minutes. What do you want to talk about? What do you want to talk about today that's important to you? This is your show. I mean, it's my show, but it's your show.
Well, there's been some changes in the tax law for the new year.
I got Michelle Gallagher coming on next week about tax code.
Yeah, well, I'm just going to talk about RMDs, required minimum distributions from retirement accounts.
Okay, that's important.
Okay, and
because you handle retirement
right,
accounts.
so we're going to talk a little bit about retirement accounts.
All right, so when I come back, I'm going to say
funding and distributions.
When I come back, I'm going to say, hey, during the break, we're talking kind of about retirement accounts and some changes. You want to go through that?
Sure.
So this is our second show. So
today?
Yeah, because next week I have Blake's graduation from AIT medic school. I have Blake's graduation from medic school next week.
Oh, cool.
Yeah. Oh, I think I start that all over.
Try it again.
Are you guys messing up over there?
The new guy.
Yeah, I thought this was live.
Nah, yeah. This is what's good about it. Plus, I get my Saturdays back.
Real Estate Jerky is back on Power Talk 1360. Chew on that.
That's right, we're back. And if you're just tuning in, I'm Ed Parcaut, mortgage advisor with Lending for a Living, and your host. And I'm here with my guest, Tom Bryant, expert financial advisor and managing director of the investment consulting group here in Modesto. Tom, during the break, we were talking about retirement accounts. You want to go through any changes that happened?
Funny you should ask.
Okay.
Ed.
Yeah, that was kind of
there have been some changes in some of the retirement accounts.
Is that IRAs, 401k?
I was going to go through them.
Okay.
The IRAs, there's been no change in terms of the contribution limits, but for 401,
So let's back up. So if somebody doesn't understand what an IRA is, can you explain that to them?
it's an individual retirement account that someone that's not involved in any kind of qualified plan through their employer can make contributions to fund their retirement. All the growth that occurs in there is tax deferred, and whether it's a traditional IRA or Roth IRA, it could come out tax free or fully taxable, depending on whether or not you need the tax deduction on the contribution.
Now, can't you have a retirement account and an IRA?
Depending on your income level, yes, it's possible.
Okay. All right. Sorry, but I didn't mean to cut you off. I heard in your voice you really didn't want to explain that. Next.
Well, it's a lengthy explanation, and you're going to have a tax expert on here later on. So,
yeah. All right. So the next one was 401k, 403b.
403bs, 401ks.
And if people don't understand the differences, one's a nonprofit for a nonprofit, one's for a profit.
Or give me a call.
Yeah.
It's call Matt. It's
What's Matt's number? No, what's your office number?
209-577-5704.
One more time.
209-577-5704.
And ask for Matt Bryant.
Yeah, Matt will talk you through that. Talk your ear off. Simple IRAs, SEP IRAs, these are all different kinds of retirement plans that are available. The limits have gone up about $1,000 depending on which plan, but generally last year you could defer $24,000 if you were over 50 years of age in a 401k or a 403b, and now you can defer $25,000. And so that's increased $1,000. And also...
Is there any way to make that up if you didn't put in beforehand, like over years? Can you add more in?
No, you cannot add more than the limits. Unless you're a public employee, and then you might be able to buy some years if you worked and didn't contribute.
Or you could do some other plan, right? There's some other plans where you can put in more money.
But they're
right?
not-
But they're not 401k.
Right, there's simple SEP IRAs if you're self-employed and probably have no employees whatsoever. Very good for realtors, by the way. Those that are independent agents
And also realtors.
or realtors, those that sell real estate. However you want to
Because
pronounce
I
that.
haven't had a lawyer.
Lawyer, yeah.
It just messed me, Tom.
No, it's all good. My tongue is twisted. So let's talk. Let's go further. Okay, so retirement accounts. We've talked about the minimum or the maximum contribution limits that have been increased for all except for IRAs and Roth IRAs.
Right.
there's been a change in the required minimum distribution. So it used to be that if you were 70, on the year you turned 70 and a half last year, you had to start taking distributions from your retirement plan, regardless of whether you wanted to or not. The IRS required this so they could gain their taxes, their revenue from the taxes.
And before, what was that? Is there a percentage?
It was an actuarial determined decision number. So the younger you were, the less it was. So if you're 70, you take out 2 or 3%. When you're 90, you got to take out 10%. So it grows every year, and it has to do with your life expectancy. Yeah. Yes. So those were called mandatory required distributions, and so they have changed that so that as of 2020, you don't have to take those distributions until you're 72. So the RMDs start at 72 instead of 70 and a half for the newcomers. So unless
you got a year and a half more.
Right. But of course, you'll have to take out a higher percentage because you'll be a year and a half older. But they've also taken away something that was a big help for beneficiaries. Non-spousal beneficiaries, when they inherit their dad's IRA or mom's IRA, now only have 10 years to take the distributions. It used to be they had what was called a stretch IRA option. They could take it out over their lifetime. Now they're limited to 10 years. So if you inherit $1 million from your dad in his retirement account, you used to be able to take that out over your life expectancy. The IRS required that you take out a minimum amount, but it was determined by your life expectancy. So if you're 40 and you're in your peak earning years, you would have to take out a very minuscule amount. Now if you're 40, you got to figure out, I got to take that out over the next 10 years. And it can have a big impact on your income.
A big impact on your tax bracket.
Absolutely, because if you're taking out a tenth of that $1 million every year, you've got $100,000 extra earned income. It looks like earned income. So that's their way of, the government's way of adding revenue and trying to be revenue neutral, but they're adding revenue to the
So basically take off 10 years.
Yeah. Yeah, take 10 years off is
and
the
just
solution.
take the distribution.
If it's a big enough
vacation.
IRA, right? If it's a big enough IRA, absolutely.
And then when you get back, work from your 50s.
But it does change strategies for people that are doing financial planning. So, people that have a lot of wealth in their retirement accounts have to make strategic alterations in they may want to accelerate their distributions so that their kids don't have inherit retirement accounts with requiring them to take excessive distributions when they're in a higher tax bracket at a younger age. So,
well, and that's why it's important to have professionals in your life that you talk to, financial advisors, trust attorneys, so that you can have the trust set up right, so you don't have to go through a probate. So it's very important to have those people in your life.
From my perspective, it's good for your financial advisor to be a certified financial planner because they're constantly taking extra units or extra credit, more hours of study that's required, 30 hours every other year, in order to maintain that certification. So that certification sort of suggests that that individual is up on the new tax laws on an ongoing basis.
And they changed that in our industry too now, where before it was not the same education. Now each year it's new education about what changed and all the new stuff. So it's important to have somebody who's licensed on anything you do.
Well, certainly someone that's educated.
Yeah.
And the license is an indication of the education.
So now it means that, where before it never really meant that. Because prior to before you became a CPA, I mean, you didn't even have to have a degree to be a CPA. Financial planner.
CFP,
yeah. Thank you.
No, you didn't. In fact, now the requirements are you have to have a bachelor's degree and at least 4 years in the industry before you can even set for the exams. And then it's an extra year of studying. It's like a graduate level course in order to get that designation.
Well, if you have somebody telling you how to do your money and where to put it, you would expect them to be educated. Where the sad part was, back years ago, they didn't have to be. And I mean years like 10, 20 years ago, right?
Yeah.
I just got my high school diploma.
There,
and I could be a financial planner.
There are a lot of people out there that still will come to your house and roll up their sleeves and sell you a product, and that's not what you want to look for.
All right, so minimum distributions now is a major thing.
It is. If you're not in a position where you are forced to take a minimum distribution now, and you turn 70 and a half after January of this year, then you have a distinct advantage in planning for your distributions, but you have a disadvantage for planning for your beneficiaries other than your spouse. Your spouse will have the same benefits you will when they inherit your retirement account, but your kids will not. So it's something to look at, something to consider.
Yeah, because you need to, look at changing if I don't, if I'm only going to last another 10 years or so, and my kids are going to get it after my wife, it's huge stuff.
Yeah, there's also a change in 529 plans.
And that is the
college-bound savings plan that you can fund. And the change is that you're now allowed to take tax-free withdrawals to repay student loans.
Oh, really?
Which in the past, you could only take the tax-free withdrawals to replace or pay for expenses that were generated through the education process. But now you get to take a deduction up to $10,000, which if you had a large enough 529 plan, I don't know why you'd have student loans in the first place. So it's kind of a moot point. But
well, you could have funded it for your kid and then pay your own student loans.
No. But I like
you like that idea?
Yeah, that's clever.
I was trying.
Yeah, there's also one other thing. I have to back up. There's also one other thing about the IRAs. You're allowed to take out money now to pay for the birth of or the adoption of a child. So you're allowed to take a penalty-free withdrawal in order to cover the costs of the birth of a child or the adoption of a child. And this is at a limit of $5,000.
Out of your IRA.
So you can take before you're 59 and a half, you can take a $5,000 penalty-free withdrawal to either have a child or adopt a child.
And it has to be your child. Right, not somebody else's.
Yes. Well, I wouldn't want to adopt your child, although they're great kids.
Yeah, they're all gone. That's what makes them so great. They're all in doing their own thing. So what about they're still? And if you don't know, that's okay. I can find out next week. Still able to take out of there for your first home purchase?
Yes.
Okay. And that's the withdrawal, or if you have to do payments depending on your plan and all that kind of stuff, because every plan is different when it's your 401k.
Yeah, well, 401ks are different from IRAs, so that would all depend on whether or not the plan sponsor, the company that you work for, wrote that into the plan, and a lot of them don't because it makes administering those plans more difficult. I'll quit moving my chair.
That's okay. Everybody can see on YouTube that you like to swing your chair. Yeah. It's okay. We got to go for a break, so I'm going to stop it there. We'll come back and pick it up. All right?
All right.
As many as you know, I'm a veteran and believe in supporting other veteran business owners. So if you know of a veteran business owner who would like the benefit of our audience, home buyers, sellers, owners, get them in touch with me at 209-846-9270, or you can do pound 250, say the key phrase real estate jerky. Today's shout out will be veteran realtor Jose. Oh man, I'll talk to him later about this. That Keller Williams Halstead team in Lodi. Veterans, let me know. Again, he's great at the VA home program loans and also the purchase. So call me if you have anything, or call Jose at 209-499-5293. Again, that was 209-499-5293. Jesus, I should have read that ahead of time. Hakura. Hardigi. Sorry, I wasn't looking, and then I was like, damn.
I just knew you'd get it because you had it last time.
I know, but I was like, I did, to be honest with you, I jumped and I did the end piece, but I didn't read this part.
I actually
listened to Tara's program last week. I was stuck at Costco for an hour and a half waiting for my wife to have her eye exam, and you guys did a great job.
You mean Amy?
Tara, Bryant.
Oh. Yeah.
Tara.
I was thinking the other Tara.
Well, Tara got all nervous too. She was funny. Because she didn't see the email with the script. So she walks in here and goes,
what are we talking about?
I go, girlfriend, I sent you a script. She went, I get it.
Actually, she was much better this time than the first time.
I didn't hear it the first time.
Yeah, she was really much better this time. But it helped having you next to her. So.
She was good. It's a great program.
No, I'm just saying she was.
It's a great program. I'm do it again.
Even though she didn't know the subject that you had ahead of time, you wouldn't know.
No,
no,
because she knows that program.
So really we were at Costco, and I had to run some errands. We went to the airport and had breakfast. I went and bought some clothes at 529 or at 511 Tactical, whatever, Crescent Supply. And then we went to Costco, and we were done at 11 o'clock. And my wife says, "Oh, I have an eye appointment here at 12. There's no reason for you to drive home or for me to drive back. Can you just wait? So I had 2.5 hours to sit there in the shade in my truck.
All right, so you have on here about Matt's coming back here talking about the 529 savings plan for college, the debt loads.
He just talked about it.
Huh? We kind of went over that already.
Yeah, we did.
So, what do you have on your little notes over there you want to talk about?
Should we talk about more about the market?
Yeah, what part? Any particular part?
Yes.
I can just
Maybe
like
we
quickly-
should prognosis. What's going to
Yes.
happen?
Yes.
Yeah. Well,
Absolutely. That is absolutely what I want.
all right, yeah. So 12 minutes and then 9. Wait, so it's almost over.
I'm done. I got nothing to talk about.
Yeah, sure you do. You can
Nothing
just talk
else was-
slower.
How's this? Yeah, I know. I got a call from my insurance agent. What's his name?
Oh yeah, Neil.
Neil Grossbeck's one of his girls, and she was talking so fast. All I got from the phone call was Neil Grossbeck's office, and I told her, "Okay, I got the Neil Grossbeck's stuff. Can you talk slower now? And take the gum out of your mouth."
Are we gonna start?
Ready?
I thought you. I didn't know he was waiting on it.
Real Estate Jerky is back on Power Talk 1360. Chew on that.
That's right, we're back, and I'm here with my guest Tom Bryant, expert financial advisor and managing director at the investment consulting group here in Modesto. During the break, we're talking about certain things, and what do you think the market's going to do? Think 30,000, 33,000 Dow,
Funny you should
40,000 Dow.
It's funny you should ask. I believe that the economy is as strong and as healthy as you and I have ever seen in our lifetime.
So it's a bull market.
I believe that whenever I don't know. The answer is I don't know.
Yeah, nobody ever knows.
No one ever knows. And so I always advise people to I always advise people to spread it around.
Yeah. Well, if you want them to hear you, you have to talk into the mic.
I always advise people to spread them around. My headset died.
You're good. Keep talking.
Okay. So I advise people to spread it around. You don't put all your eggs in one basket, and those are cliches, obviously, but it is true. I don't know where the market's going. The market's making new highs today, and it is a trend at this point. So I want my clients to be participating in it. When the market decides to decline, and it will on its own, it's self-determining. It's an animal of its own. It will a bull or a bear animal.
Well, the thing about bull, I was like, what is it? I didn't understand. It's the fighting style of the bear, right? Bear paws down. That means it's a down market, and the bull does its horns up, right?
Correct. That's right. The bull has his head up, and the bear has his head down. Right. So I'm inclined to be a bull at this point, but market sentiment is such that people are beginning to think that they've missed out. And when the money starts flowing in without any resistance or hesitance, then I would be more inclined to think that the market is beginning to top out. And we are coming into some events later this year that...
You mean the political arena?
that might put some fear in the market. But at this point, I'm thrilled with the performance and the returns. Last year, we outperformed even what I expected. But interest rates are in check. The economy is as strong as it's ever been, as I've ever experienced, and inflation's in check. So there is really no other place to go except for equity markets. Gold had a little blip here recently because of some fear. But if we have trade barriers lifted, and it looks like there's some progress being made there, then I believe there's no reason for the market to continue to go up for at least the next 6 months.
Wow. And, I know like Australia's on fire, but they've had a market that's been growing for 26 years. I mean, we haven't seen that, right? We normally see cycles of, 10 years or 8 years, and we go through something major. So this is unusual for us, unusual territory, so everybody's scared. I mean, I'm shocked rates are where they are right now, right? Normally when we're doing so well, we're in the sixes, right? In my history, I've been doing it for 25 years, seeing rates in the threes again. Even a cash out refinance, I quoted somebody 3.75 or 3.625. I mean, and again, we won't get into all that, but I'm just examples. Those are normally 4.75, 5%, 5.25. It's astonishing to me that we're here still.
Well, when you're as old as I am, and I don't consider myself old unless I look in the mirror, you remember that when I first got into this business, mortgages were at 15%. You could not afford a house because you couldn't afford to borrow the money. And now at whatever mortgage rates are,
low.
Something, they're very low.
Really low.
But treasuries, U.S. treasuries were at 15%, and now they're at 2.25% for a 30-year treasury. So
and 10 years at like 1.87.
yeah. So the whole thing has changed. Everything's changed, and the averages are way down in terms of what the cost of money is, and so that pushes or accelerates the demand for those investments that have a higher return. And when you can go buy a stock that pays 4 or 5% in dividends, why would you buy a bond or something else that gives you less return? So that's what's making the market go up. And higher earnings and lower taxes on the corporations.
So again, a tax break for the wealthy. I'm just kidding.
No, if you own an IRA or a 401k, then you have benefited from the tax break that goes to the corporations because they have put that money back into growth,
right,
or back into the shareholders' hands. And we're all shareholders if we're participating in any kind of retirement plan.
But do you know how many people don't invest in the market? Do you know a percentage of people? Do you know that number? I don't have the number. I'm just curious because they're always saying that not everybody's in the market.
Everybody that I know intimately is in the market.
That's your family.
No,
anyway.
Well, no.
But I'm just.
If I know you well, I know that you're investing in some avenue. If you're buying, if you have an IRA or a 401k, you're in the market.
Right. But not everybody has an IRA or 401k.
Everybody that's buying a house generally has a job, and if they're gainfully employed, they're either in a retirement account unless they're self-employed. But if they're working for a company, they're generally being forced into a retirement account at this point.
Right.
Mandatory enrollments are now the norm in 401k.
Oh, so there is mandatory enrollments.
There are. Okay. Most companies now are forcing a mandatory enrollment.
So for me, with the Fed funds rate so low, right? If we got into trouble, we have nothing to do.
What kind of trouble?
I'm just saying if the market goes, say the market tanks, right?
Okay.
So everybody takes their money out of the market and now buys bonds, right?
Everybody can't take their money out of the market.
Well, I'm just as an example. When people get scared, right? People don't buy stocks; they buy bonds for protection. And the Fed funds rate's what, 2% or something around
1.65.
Yeah, okay, I knew you would know. You can't lower it that much more. We're going to go negative.
We were almost to zero. We were at 0.02 or 0.002, I think, for a moment. Yeah.
But I'm just saying. But look where rates are now. I mean, to me, it's shocking to see what's going on. I'm good with the market where it is. The problem I have is we don't have enough homes for people, right? People got jobs. They're making good money. They want to buy a home, but they can't because they got 15 other people, making offers on the same house still.
So it's not a good time to buy a home?
It's still a great time to buy a house. It's just harder. So what I'm telling people, what I'm running into, like other areas, it's all location, right? Tuolumne County was having issues with fire insurance. So people who've owned homes for 20 and 30 years said, I was only paying $600 a year. I'm not paying $3,000 a year, so I'm selling my house at $50,000 off to get rid of it. And they put 60 houses on the market, right? Mm-hmm. Well, what that has done is people who couldn't afford a house before now can buy that house, even with the insurance, getting it, $200 a month, which most of our insurance on regular houses down here in the Valley are only $65, $70 some dollars a month. They can afford the payment up there now that they couldn't afford before. So what I'm getting at is it's a great time to buy. You just might not be able to buy in Modesto. You might have to look in the outside areas, look somewhere else to buy.
Wow, people commuting to Modesto because it's too expensive to live here.
The rents here are ridiculous. It really is. I mean, for most people, the average person here in Modesto, the rents are very expensive.
There was an article in the Modesto Bee this morning.
This week.
Was it this week?
Yeah.
It was not this morning?
I don't know.
I think it was this morning. Oh, that's right. It was this week. I live in the past. suggests interest rent is at $1,350, I think, average for apartments.
Yeah. Worse than that I'll give you an example. That's apartments. That's not a house. The average house is probably 2,000 plus for an average house, right? 3 bedrooms, 2 baths, average house. Tuolumne County, I have people who were leaving their rents, right? They had to leave because people are going to sell the house. They were paying $1,600 a month. The next house is $1,800 and $1,900. They could buy for $17.
Wow, I should move down to a trailer down by the river and rent out my house.
You should. Or don't sell it because you're going to have a capital gain.
It'll be my cash cow.
Yeah, there you go. Yeah, I mean, and that's why a lot of people go, why do I want to sell my house right now? You know, if they move to some other house, why sell it? I rent it. Make 10% a year right now still in Modesto. On average, that's what the
so is that the
core
average?
Logic is saying that our average has been 10%.
Yeah, well, if you would spend $300, I don't know what the average home costs now.
Above 300. It's whatever the FHA loan limit is basically what you're at. So probably 350, 370.
Wow. So if you could buy a house for $400,000 and rent it out for $2,000 a month, that's a good cash flow.
If you can.
Yeah.
Good luck finding that.
Wow. That's a good deal.
Yeah. Well, I mean, that's the problem is there's a lot of people who bought homes and they rent them out and just rents are expensive. And a lot of people hold on to them. And there's still I think, talk to your tax advisor. We'll have somebody on in a week. You can call in and talk to her. But basically, you know, if you move out of the house as your primary residence and buy another house, I think you still have 2 of the last 5 years that you live there. Then you can sell without any capital gains. So
your primary residence.
Your primary residence. Like if you move out of that and buy another home, you can still rent the primary that was there, and you have 5 years, and you have to the last 2 years. You have to before last 2 years sell it.
Oh, I didn't know that.
Yeah, capital gains. It's still there.
I understood the capital gains, but I thought I had to live there for 2 years, and that was it.
2 of the last 5.
Oh, okay. So if I lived there for 2 years, I could rent it out for 3 after that.
Right.
And still sell it. And
that's what we did when we moved from our keepsake.
The no capital gains. Oh,
yeah. So.
Well, that's good news.
Well, the problem was before people would rent it for 10 years, move back into it for 2 years, and then sell it with no capital gains. They got rid of that rule.
That's too bad.
Yeah.
Well, they've got to generate revenue.
Well, that's what people have a lot of homes, and I'm moving into this house for 2 years. Now I'm going to sell it. Going to move in that house for 2 years, and then I'm going to sell it.
Avoid the recapture and all that stuff.
They want, they got to have their tax money. How else are they going to pay for programs?
There you go.
Yeah. But, anyway, so we have about a minute for a break. Anything you want to add in there before we go to break? Because you got about 30 seconds.
Well, I got to tell you that I have a real hard time right now buying bonds for clients because the interest rates are so low. So it's really put us in a bind. If we want to buy bonds, we're buying very short term, 6 month at the most. And
you're not talking treasury bonds.
I am talking treasuries.
Okay.
Yeah, treasuries are the most liquid and the safest. So we're buying bonds only for safety, not for growth. And it's the money that we're putting aside for waiting for that big pullback in the market so we can fund more money into the market. People are afraid. They're looking for a 10, 15% pullback, and that provides them with the opportunity to buy more at a cheaper price. Imagine if houses dropped by 10% in a week.
Right.
There'd be a frenzy.
Hey, let's pick it up when we come back, all right? Hey, it's time for a break. Remember, you can listen to us on our podcast via 24/7 at iHeartMedia. You can always watch behind the scenes on YouTube video anytime, and then it's a great opportunity to hear the extended conversations because it's behind the scenes. Just Google us, Real Estate Jerky. You'll find us. And remember, if you have any questions, you can contact us at #250. Say the key phrase Real Estate Jerky, and we'll be right there. All right, we only got 9 minutes left.
I got nothing else.
Yeah, you do. We can go back to the bond thing.
Talk about whatever you want.
So let's talk about safety. All right, so let's bring up about the fact that you said that people are going to go to safety just in case they pull back. Let's talk about that. Is there anything other than bonds for safety? Don't say it right now. Tell me on the air.
Is there anything else?
You know what I mean? If you don't want to go into bonds.
Guns and ammo.
Gold.
Oh, gold just spiked, man. It's scary.
Well, remember last time you were on here, you were talking about gold and how to buy gold, not to actually buy actual gold, but to buy whatever. So let's bring. That's what I'm talking. We'll talk about that.
Yeah, gold spiked, but I looked at some charts the other day about gold for the last 10 years. What a loser investment.
So we'll go to. So we got 9:20, and then I'll just say thank you for being here, and say thank you, and I'll turn off the mics because I already did our outro.
Outro.
Or out. Because I have this long thing that Marlene has me do each week down here. It takes about a minute. So I recorded it before you got here because it was during the last segment.
Because I was late getting here.
No, you're perfect. All right, so you have nothing else to talk about. Come on, you talk about stuff all day long with clients. What's the number one worry people have besides the market crashing?
What are people worried about? Health.
You guys ready? All right, you ready?
Nope.
Nope, I'm not ready.
Leaving the bull behind. It's Real Estate Jerky.
That's right. We're back for the final segment of the show. I'm Ed Parcaut, mortgage advisor at Lending for Living, and I'm here with my guest, Tom Bryant, expert financial advisor, managing director of the investment consulting group. Can you believe it's almost over there? You only have about 9 minutes left to talk to
I'm
me?
having a ball.
So before break, we were talking about people are putting money in short-term bonds, right? The treasury bonds, right?
We've been utilizing my
you
office
have-
short-term treasury
Well,
bonds.
I'm talking about what you're doing, all right? Most people flight to safety, protection, they go into bonds, right?
A lot of people, we use bonds for...
My whole life I've heard this through in my industry because they look at the 1-year T-bill to kind of figure out where mortgages are going, even though they're not the same thing. We use mortgage-backed securities. But it's always been there that when people are economically don't understand what's going on out there or they're worried, they go to safety. And safety technically is bonds. That's what I heard.
That is correct. So we utilize bonds in our portfolios as a safe haven for that money which we do not want exposed to the equity fluctuation. So in other words, if people are afraid of the stock market, we put money into bonds. We take some of that money and put it into treasuries. The reason we're stumbling with that is that long-term treasuries, 30-year, are paying about 2.5%, and short-term treasuries are paying, let's say 1 year, are paying right at 1%. So the spread between 1 year and 30 years is 1.5%. And so if we want to go out and grab a real rate of return in a bond, we have to buy a 10 or a 15-year bond in order to get any return at all. So just even keep up with inflation. If there was
you're saying a 30-year bond to keep up with inflation.
Just to pay the same amount as inflation, less taxes, you're a loser. So if I've got a bond, a 30-year treasury that's paying me 2.5%, and I'm paying taxes on that 2.5% because it's ordinary income, it's only taxable on a federal level, not a state level, because it's a federal security.
Give it time.
The
State of California figure it.
Then the problem is if interest rates were to spike up, which is then I would be in a situation where I'm losing money. Right. So my safe investment is a loser. And it used to be we could go out and buy a certificate of deposit and get 7 or 8%, and we didn't have to worry about it. Now we go out and buy a certificate of deposit at the bank and you get 2%. Well, if interest rates go up, you're a loser. So it's a difficult proposition for money managers to be in, and for anybody out there that has excess cash, they don't know what to do with it. And so basically we're in a situation where we can grab 1 or 2% and just wait and see. So that money is sitting there looking for opportunity, because where it's at in short-term treasuries or in certificates of deposit, there's no opportunity. You're losing money, because if you got, remember, 2% CD after taxes, 1.5% maybe. Inflation 2%, 2.6, something like that. You're losing money. You're in a negative situation. So you have to be in a position where you have growth potential. That's why we're heavily invested in the stock market.
Well, let's say somebody has $100,000 in a CD, right? Because I've seen that.
Oh, so have I.
I've seen that in clients of mine.
Breaks my heart.
Right. What should they do with that then?
Well,
if they shouldn't be in a CD and they're trying to go for protection because they're in their 90s or 80s or whatever, 70s, is there some other safe place to put that?
Well, there's a lot of places to go, but the expectations for return aren't as great as they used to be, because interest rates can't go down that much further. So there are insurance contracts where the insurance company actually takes the risk and you can get a little bit better return. These are called annuities, and Ken Fisher says he'd rather kill himself than sell an annuity. But I mean, there are options within insurance companies who they'll mitigate the risk for you, and you can get a better return than you could getting in your certificate of deposit. But the stock market is still the place to be. Large cap U.S. stocks have been the place to be, and it is my belief that for the next 3 or 4 years, given a positive outcome
Of the election?
of the election cycle, the right outcome.
I was trying to help you there.
The right outcome of the upcoming election cycle, it should still be a good place to be, and we should be looking for 5 or 6% return.
Now, if I'm buying stock, should I look for a stock that has dividends? Or
Absolutely. That reduces the risk of the investment, because if the market's fluctuating, those stocks that pay decent dividends and tend to be less volatile, and because people tend to hang on to them and not sell them. And the big mutual fund companies like those kind of stocks in their portfolio. And remember that qualified dividends are tax preferenced to investors. So that means that they're not ordinary income like a certificate of deposit or a treasury is taxed as interest. That's like ordinary income, whereas a bond, or rather a stock, those are qualified dividends. That money that comes from that company has already been taxed. The company's been taxed for their profits, and so that money comes to you as a qualified dividend, and it has tax preference. So it's treated differently and taxed differently.
now, I know that sometimes you can take that dividend and rebuy more stock.
Absolutely.
And should you do that?
Depends on if you need the income or not. We like our clients to let us reinvest their stocks, dividends into more stocks. We generally tend to aggregate those dividends as they collect, and then when the opportunities arise, we take that money and invest it in more stock, generally those stocks that have underperformed or are in some sort of pullback for one reason or another. And so we like to reinvest the dividends because then our portfolios grow faster and we make more money.
Right. Now, is there anything to protect yourself against rising rates? Like when rates are low, you can buy some type of security or something that protects you against, like with rates go up, you get paid, you make, in my industry, we were told by one of our gurus, there's some, and I can't remember what it is now. Otherwise, I'd tell you what it was. I can't think of it.
Well, the best way to protect yourself against rising rates is have short-term treasuries.
Okay.
Because the shorter the term, they allow you
But
to.
then you just said it's taxed as regular income.
Right, it is.
So
a rising rate environment's not necessarily a good thing. It usually is indicative of some sort of growth. So generally, if we're in an inflation environment like the Fed thought we were, he was afraid of hyperinflation, so he raised the rates a little overzealous. So then he had to back off and reduce the rates a bit. And that sort of precipitated the final rise in the market that we got in November, December. But it's difficult. Gold is often considered a hedge against inflation, but it hasn't really panned out in the last.
Oh, that was funny. We're in California.
I
too.
got it.
Yeah. But now, if you buy gold, you don't want to go out and buy coin, right, or whatever. You want to buy what, bullion? What do you want? What type of gold should you buy?
The best way to buy gold, from my perspective, is just to buy there's a ETF. It's called an exchange traded fund. It's the symbol is SPY or Spider in. Nope, that's the S&P 500. The gold is GLD. I'm sorry, that's the symbol. But you can go out and buy that
it's
just
the
like
same
a
as
stock.
it's spelled.
Yeah, yeah.
Remember that.
Somewhat
really easy.
GLD.
Yeah.
But you can buy
Just add O.
you can buy the kind of like buying an index, but
Okay.
you don't have to actually take possession of the gold, which is very expensive. You buy and sell gold bullion itself. There's a great expense involved.
Because you got to check it, right, for if it's pure gold
Assay
or not.
test, they have
Yeah.
to check it, and plus the commissions are ridiculous.
Are they?
Yeah, about 10% on both sides.
Is that the same with the coins and everything else that you see where people buy coins?
Yeah.
You know?
Well, they're not subject to a test in terms of the purity, but generally, yes, you go to a coin dealer if you
Right.
want to buy and sell the coins, and the coin dealer likes to make a profit.
Of course they do. Everybody wants to make a profit.
Their profits their cut's bigger than mine.
So you have about 30-ish. Anything else you want to say in there? I want to thank you for being on today. I really appreciate it. I know this last segment you're like, I have nothing to talk about. You always have stuff to talk about.
Well, if
Tom.
you ask a question, I always have an answer.
Well, I try to ask open-ended questions. So.
Sometimes the answer is I don't know.
Right, but you'll find out.
Yep,
and that's what's good about you. Why don't you give your phone number for your office so that if people want to get in contact with you?
Certainly. It's the Investment Consulting Group, and our number is 209-577-5704.
Thank you, Tom.
Thank you.